When most people invest, they focus on what can go right, focusing on the upside of the portfolio. However, fewer people focus on or give as much attention to the downside, either in terms of what could go wrong with an investment strategy per se, or more pointedly, what can go wrong with the estimation approach leading to that investment strategy. Not just the outcomes, but the inputs into the outcomes you're anticipating. With this in mind, Charlie Munger, for example, had this saying that you should invert, always invert. Focus not just on what can go right, but on what can go wrong and what can hold you back from the outcome that you desire to achieve. So in the investment context, I recently spoke with Ozbiz about this concept, and here's what I had to say.
So this week on Wealthy and Wise, we're exploring one of the most powerful ideas in investing. Invert, always invert. Sometimes the best way to build wealth isn't finding more winners, it's avoiding the mistakes that destroy it. So that is where we're taking this episode. Let's add some value. So I'm told great investors don't just look for opportunities, they spend just as much time identifying risks. In this segment, we'll explore Charlie Munger's famous mental model of inversion and why asking the opposite question can often lead to better investment decisions. Joining me, Howard Coleman from Team Invest and Mark Humphrey-Jenner, who's joining us from the University of New South Wales. Gentlemen, welcome. Mark, welcome back to the program. Maybe I'll just start with you, Howard.
Sure.
What do you think Charlie Munger meant by invert, always invert?
Well, I think there are really two parts to it. Most people get excited about what should I buy? What's going to make me money? And he was saying it's easy to get carried away with all the opportunities in something, but what could go wrong? What could cause that investment to in fact lose you money instead of making you money? And that's what he means by invert. The second thing, of course, is that for every company on the stock exchange that is likely to make you money, there are several others that never make a profit and almost certainly will lose you money. So if you're focusing on what could go wrong, you're much more likely to avoid all those losers out there that mean average returns are generally on stock markets 7 to 10%. You can do a lot better than that if you can simply avoid all the losers.
So Mark, maybe I'll ask you, are humans just naturally sort of bad at this? We tend to focus on what we want instead of what could go wrong?
Yes, naturally it is more difficult to focus on those other aspects. So another way of thinking about them is they're often the second order effects of what the investment involves. So for example, people might focus on how do I make more money, but they don't necessarily focus on how do I not lose money. Or for example, say they're trying to generate a portfolio. They're looking at mean variance portfolio optimization, to use just one example. They're looking at, well, how do I get the best stocks into my portfolio optimization? But they don't necessarily stop to ask, why is it that my portfolio optimization is simply not going to work? Which, for example, is why you get the juxtaposition between mean variance portfolio optimization and minimum variance portfolio optimization, which tackles the idea that maybe it's because it's very difficult to measure expected returns. So you focus on something you can measure, being the variance. And that's just one of many examples. You can see it, for example, in how people are doing budgeting. Instead of asking, well, how do I avoid losing money? They just focus on how do I make more money? But often, avoiding losing money, whether it be your budget or be the federal budget, is often at least as important, if not potentially more important, than just that first order question.
Yeah, Howard, because I think to Mark's point about those questions that you must ask, investors want to know what makes stocks a winner. But how would a value investor, how would you, or a good investor, you could say, approach that differently?
Well, to start with, you approach it the same, because the first thing you do is you say, excluding all the obvious losers. So I can chuck out 800 companies on the ASX out of about the 1900 that are there, because they never ever have made a profit. Of the remaining ones, how many of them have too much debt? Okay, I can chuck them out as well. So you can do a few eliminations, and you then land up with probably too many companies for your portfolio. Now you want to look at those in depth, but seeing as you boiled it down to a relatively small number, you can look at them in depth. You can't look at 2,000 companies in depth, but you can look at 40 companies, for example, in depth. And when you look at those, you already know that they are not obvious losers. So it's no point focusing on how big a winner will it be. It's going to be a winner. What you've got to decide is what could go wrong that could stop it being a winner. So a company that looks absolutely fabulous, what are the risks? What are the things that could go wrong in this business or with this management team or in society or in the economy that could cause this to be a poor investment, even though on the surface, in first order thinking, it looks like it's guaranteed winner. And that's really what Charlie Munger was talking about. He was saying, Warren and I get so many proposals all the time. We look at them, we eliminate all the obvious ones we should eliminate, and then we're left with several that, rather than saying what could be wonderful about them, say, despite the fact that we think they're wonderful, what could go wrong? And we spend quite a lot of time in Team Invest meetings talking about the risks. What are the main risks? And we score the risks for likelihood of happening. So some risks are more likely to happen than others in the next 10 years or so. And how much damage they would do if they happened. Because sometimes you get a risk that's very likely to happen, but it doesn't do very much damage, so that's not that big a worry. Other risks may be very unlikely, but could destroy the entire business if it happens. So we've got a system of weighting and scoring that in order to get a better understanding of how much damage that could cause. And often with terrific companies that on the surface look great.
Yeah, but one of the hardest things I think for investors is really to admit when they're wrong.
Yep.
So Mark, how does inversion help sort of remove some of the emotion, potentially some of the confirmation bias even from investing?
It's often a little bit easier said than done, and also easier for people who have lasted through many different market cycles, because nothing disciplines the mind like losing a lot of your own money, which could happen during a financial crisis or a Greek debt crisis, which was a particularly painful situation for myself, for example. So you start to look out for what could go wrong and then focusing on what is it about your investment technique that is causing that. So for example, have you been focusing too recently on what has gone wrong, what has gone right, and where you've been able to successfully predict, for example, foreign exchange movements? But then you get potentially overconfident. So it's a matter of training yourself to identify where you might be making an error and then taking a step back and trying to avoid that error. Now, it often comes with practice. Professional investors or experienced investors who have invested across many cycles will be naturally a little bit better at this just because they've already observed personally what goes wrong. The people who will have more difficulty, of course, are those who have not observed the cycles and or those who have not personally felt the problems associated with them, thereby not quite having the same salience. That lesson won't be quite as in-depth or impactful as it might otherwise be.
Yeah, well, Mark, I think you've raised an interesting point, because is inversion particularly important today, perhaps when you've got a lot of this enthusiasm around AI, a lot of these blockbuster IPOs coming to market overseas, technology and disruption?
Absolutely. And I'll give you another recent example to show exactly how this goes wrong. We all remember I'll call it the startup bubble that occurred during COVID, where there were a lot of very high valuations, a lot of companies that, particularly startups, that could effectively select their investors, and they could go to investor meetings and impose pressure on their investors to invest now. An example of that is FTX. And we know how FTX went. It imploded and was a disaster, in large part because many people didn't quite observe. Maybe they didn't do the due diligence, or maybe it was covered up and they needed to dig a lot deeper. But regardless, there are a lot of governance failures. So in periods of exuberance, often you get a lot of that just not being emphasized. Now, focusing on AI, still because of what happened with that wreck recently, the startup wreck that occurred during COVID, that's still fresh in the mind of some people, and they can still see what went wrong with NFTs and the like. And it's still applying some of that to AI. So it's important to apply the learnings, be skeptical, but not necessarily infer that everything is a hype-driven bubble, because there are parts of AI that will make genuine money, or there are parts of AI that are perhaps riding on loss-making businesses at the moment, and one needs to ask how they become profitable. So it's a matter of disentangling the positive and the negative as well.
Yeah, so it kind of goes to a Buffettism. I'm the one that's going to be quoting Buffett this time for the first time, saying you don't need to do extraordinary things to get extraordinary results. You need to avoid big mistakes.
Absolutely.
And so do you get the feeling that, to Mark's point, in this very hyped environment around AI, that it's even more important to think about what could go wrong?
Absolutely, because we're being bombarded with things that would cause us to be over-optimistic. I mean, one example is an IPO. Now, everybody looks at IPOs, whatever it's for, and says, wow, what an opportunity, I get in on the ground floor. What they don't realize is, why is the company at the moment going for an IPO, and why is it putting together a marketing document to persuade you to part with your money and give it to them? Now, if you look at all IPOs in that lens and you say every IPO is really a marketing document trying to persuade me to part with my money and give it to this company, then you start looking at it a lot more rationally. You don't say, oh, I'm getting on the ground floor. You say, what could go wrong if I invested in this company? What are all the things that could go wrong that could cause this to be a terrible investment rather than a good one? And nobody goes for an IPO saying, let's raise as little money as possible per share. They say, let's get as much money as possible per share. After all, that will give us a higher valuation. So if you look at an IPO as what could go wrong if I invest in it, it's a marketing document, you'll probably be a lot fussier on the ones that you invest in. And the same applies to anything that's not an IPO. If a share price has been rising regularly, most people get enthusiastic and say, I should buy it. But the whole reason it may be rising regularly is all the people who were smart about it bought it when it was cheap. It's now no longer that cheap. So you've got to say to yourself, is this actually a reasonable price that I'm buying it at? But I think the other important thing is, look inside each company that you're intending to invest in with an attempt to understand, how does its business model work? How does it actually make money? And at the moment, we've got, similarly to what we had in the late 1990s or the late 1920s, there have been several episodes in history, where instead of saying, what could go wrong with these things, everybody says, oh, new technology, it's going to make lots of money. As Mark points out, there'll be one or two of them that will, but there'll be a hell of a lot of them that are going to do the exact opposite and destroy money.
Yeah.
And, if you invest in a basket of AI companies, you're going to lose a hell of a lot of money. You've got to pick very carefully, the same as you do with anything else. Pick carefully what you buy and what you invest in.
Well, that's my last question for you, Mark Humphrey Jenner from the University of New South Wales. We've been talking a lot about this in context of ASX-listed companies, but you've brought up, FTX, which obviously was crypto. We've got many other asset classes obviously available to Australian investors. Does this sort of inversion, this thinking of what could go wrong, apply across asset classes in your view?
Oh, absolutely. I think it's the beauty of this saying, this aphorism, but also in reality, a lot of what Charlie Munger has said. And I guess I'd encourage people to check out Poor Charlie's Almanac, because it has a lot of these mental models. But focusing on invert, always invert, well, it applies across asset classes. So I mentioned portfolio management before. So say, for example, your job is as a portfolio manager and you're just looking at putting a big matrix of stocks together to determine what is optimal. Well, then you have the question of what can go wrong with mean variance optimization. In particular, parameter estimation. That can be a massive problem. So you need to dig into how to solve that. Another example is even startups. So for example, I often invest in early stage companies. So there you're looking at what could potentially go wrong and cause this startup to not be the unicorn that it says that it is. Because every pitch deck says that the company is going to be a unicorn. But the question is, what might stop it doing so? And there may be governance failings. It might be that they're miscalculating the total addressable market. It could be there might be regulatory issues on the horizon. For example, if it's an NDAS provider, that might be an example. Another situation is if you're a treasurer and you're trying to raise as much tax revenue as possible, you need to consider what might cause my measures to not raise revenue. Or alternatively, where might tax revenue decrease, or what could cause it to decrease, such as reducing investment or reducing on-flow fiscal spillover, such as stamp duty, or exacerbating a lock-in effect, those types of things might cause your plan to go awry. So it applies across the board. It's just a matter of working out the specifics for exactly what you're investing in is what is relevant to your particular asset class.
Yeah, Howard, look, value investors are all often described as pessimists who are looking for problems. So how do you balance that healthy skepticism, that work, because it is work that you've got to do, with still finding opportunities?
Yeah, and in fact, we always find that very amusing that we're regarded as pessimists, because if you came to one of our Team Invest meetings and 100 people in the room or so, you'd probably find that not a single one of them would regard themselves as being a pessimist. They would say if we were pessimists, we'd keep our money in the bank. We don't keep our money in the bank because we're optimistically aiming to get 15 to 20% per year on our investments. However, what we do realize is that if we allow our optimism to blind us to rational thinking, we're going to lose a lot of money. So we look at the moats of the company, in other words, what protects it and enables it to be a successful investment, as well as what are the risks. And because it's a big group of people, whenever we talk about a company, if there is somebody who's overly optimistic, for example, if I get carried away about some company and all the things that are great about it, there are bound to be a half a dozen people or more in the room who are going to say, but Howard, what about if so-and-so happens? Now, if you said to them at the time, you're being a pessimist, they'd say, no, I'm not. I'm just pointing out there's a potential risk over there.
Yeah.
We ought to take that into account.
So there you go. Charlie Munger's sage advice of invert, always invert, definitely holds some merit. Focusing not just on the positive outcomes, not just focusing on what can go right, but what could be wrong in your analysis that might hold you back from the outcomes that you are hoping to achieve. And that could, for example, be errors in estimation leading to your portfolio construction. For example, I use the example of mean variance portfolio optimization versus minimum variance portfolio optimization. Ideally, mean variance portfolio optimization can lead to an optimal portfolio, but oftentimes is very difficult to measure expected returns, which means that sometimes the minimum variance portfolio optimization might be more accurate. Even if it doesn't necessarily lead to the optimal portfolio, it might at least lead to one that you are, or at least more aware of what is ultimately going to result from your portfolio construction. That's just one example, but there are many others in the investment area where people need to focus on not just trying to get the best outcome, but on what could go wrong with their approach to achieving that best outcome. So you can let me know your thoughts about it in the comments below. Now in this video, I also suggested a book by Charlie Munger, or at least associated with Charlie Munger, called Poor Charlie's Almanac. I'll include a link to that in the description below. Highly recommended. But anyway, you can let me know your thoughts about it in the comments below, and hopefully I see you next time as well.